If you asked private investors what triggered this year's stock market meltdown, most would probably name the war in Ukraine. The possibility of the conflict with Russia causing a global catastrophe has hammered sentiment, but it's not the prime cause of the crash. Others may point to rampant inflation, triggered by this year's energy shock and post-COVID supply shortages. It's not that either. China's ongoing pandemic lockdowns haven't helped. But the number one threat hanging over the markets is none of the above. It's the U.S. Federal Reserve. Hello everyone, and welcome back to our channel. Today's video is about why the Federal Reserve is leading the U.S. economy to a crash. But before we dive in, make sure to subscribe to the channel for more similar content. Let's dive in. The Federal Open Markets Committee, the U.S. central bank's body responsible for setting monetary policy, raised interest rates by 75 basis points on Wednesday for the fourth consecutive time, as the Federal Reserve governors attempt to battle stubborn inflation levels in the country. Jerome Powell, chairman of the Federal Reserve and the FOMC, joined a group of journalists for a press conference shortly after the data release, shedding more light on the central bank's thoughts for future action. Markets reacted positively to the 0.75% interest rate increase, which came in as expected. But trading became more volatile as the chairman started his speech. While the written statement announcing the interest rate decision showed a new dovish sentence, further fueling the rally, Powell's press conference combated that feeling as the Fed chair reiterated previous guidance. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments, the FOMC statement read, hinting at a more dovish Fed. Powell, however, highlighted that the ultimate level of rates will be higher than previously expected, triggering an acute market drawdown. The feeling markets are left with is of confirmation that a slowdown is near, but surprise when it comes to the terminal funds rate, something that can be attested by the upswing and consequent downswing in the S&P 500 index. Around the world, markets are reeling with unpredictability. The values of currencies are plunging. Oil and other commodities are getting hammered. There is fear and panic in bond markets and on stock exchanges in Frankfurt, Tokyo, and Shanghai. President Joe Biden has met twice in the last week with his economic team, which includes the Treasury and Commerce secretaries, for updates on the fast-changing global financial and energy markets. And there seems to be almost global agreement about who is causing all this extreme and painful volatility: central banks, with the U.S. Federal Reserve in the lead. The Fed is the main reason why markets and investors are running scared, and the recovery won't come until Chairman Jerome Powell changes his hawkish tune. When he turns dovish, markets will fly again. Some reckon that day isn't far away, and investors should be ready for it. There's an old saying that bull markets don't die of old age, but are killed by the Federal Reserve. This has certainly been the case this year. The Fed could have saved markets from Russian President Vladimir Putin, just as it saved them from the global financial crisis in 2008 to 2009 and the pandemic in March 2020. All it needed to do was give them yet another blast of cheap money in the shape of near-zero interest rates and yet more quantitative easing. And it would almost certainly have done so if it wasn't for inflation. Instead of bailing out the U.S. economy, as it has done for the past 25 years or so, the Fed is actively aiming to smash a hole in the bottom by engineering a recession to stop prices from raging out of control. It has reversed decades of monetary loosening by increasing the Fed funds rate from 0.25% to 3.25% in 8 months, and shifted from QE to QT. Quantitative tightening is now shrinking the Fed's balance sheet by $85 billion a month. This is draining the global economy of liquidity, causing that crash we see around us. Fed tightening has caused havoc and sent investors running for cover. The S&P 500 has fallen up to 27% this year, while many bond investors are down 40%. Even traditional inflation hedges like gold have failed to shine. If the Fed signals, either in its statement or in Mr. Powell's subsequent press conference, that it's preparing to back away from an overly aggressive program of monetary tightening, we could see a significant market turnaround as we approach year-end. But currently, it seems highly unlikely. To be a little considerate, even though the Fed might not have started the fire, they certainly added to it. So, who started the fire? A series of unfortunate events. The pandemic, a war, and many other factors combined to create the biggest economic problem worldwide: high inflation. Now, many of those factors are also causing other problems. The war in Ukraine is spawning an energy crisis in Europe. Supply chain disruptions continue to bedevil companies that have a global footprint. What Wall Street wants is clear guidance about where central banks think the economy is heading and what their plans are. But these days, they're not getting it. The Fed is among several institutions that assumed this bout of inflation would be a short-lived symptom of the pandemic. Instead, it has turned out to be long-lasting and insidious. And now, the Fed appears much more humble about what it can and cannot do, the challenges and uncertainty it faces, and how confidently it can forecast. In recent months, getting a handle on inflation has appeared about as easy as slowing down a revved-up Corvette that's skidding on an ice field with no brakes. Still, after the Federal Reserve announced another big rate hike last week, its chairman, Jerome Powell, said the central bank will continue to raise rates in the hopes of ending high inflation, even if it pushes the country into a recession. Like the Fed, other central banks are sticking to their guns. Just this week, the British pound and the offshore yuan hit record lows against the dollar, and the United Kingdom and China stepped in to contain the fallout. The Bank of England announced a new bond buying program, and its governor promised he and his colleagues will not hesitate to change interest rates by as much as needed to do whatever it takes to get inflation under control. It's the same story all over the world. Sweden's central bank just hiked interest rates, and so did its counterpart in Norway. The European Central Bank is expected to raise rates again at its next meeting. Combine that monetary tough love with the fact that the dollar shows no signs of weakening, and it appears that uncertainty and volatility will be around for the near future. At a conference on Wednesday, Dan Ivison, the chief investment officer at PIMCO, a firm that manages more than $1.8 trillion in assets, said he is being hesitant to criticize the Fed and other central banks because this has been such a remarkable and challenging period. Right now, Ivison doesn't think it would be smart to bet against them. We think most central banks are pretty committed to getting inflation back towards target, even if that means the risk of a material slowdown in the economy, he said. So, what do you make of these economic decisions by the Federal Reserve? Are you for or against? Let us know in the comments section below. If you enjoyed today's video, make sure to drop a like and subscribe to the channel for more similar content.